If the opportunity to invest in the next major growth stock landed in your lap, would you take it? I'm guessing your answer is yes. Well, listen carefully, my friends, because in this episode of Buy, Hold, Sell, we're taking it to the experts to figure out how you can find the next undiscovered gem. Plus, our fundies will do the heavy lifting for us and share one pick for the years to come. Joining me today on the show is James Dougherty from Lennox Capital Partners and Nick Guidera from Eley Griffiths Group. Nick, I'll start with you. I'd love to know how assessing microcaps differs from the small and large peers.
I think at this end of the market, it's important to do a lot of fundamental research because typically they're under-researched stocks. You have to spend a lot of time on the qualitative functions. You have to spend a lot of time on understanding what the unit economics of these businesses look like and fundamentally going deep into industries because typically you can't rely on broker research.
Do you agree, James, or do you have anything else to add on how to assess microcaps compared to large or small caps?
No, look, I agree with Nick, and what I would say is it's generally when you're analysing a microcap versus a larger business, it's more theoretical. With large businesses, you get a lot more tangible evidence. You have trends in sales, market share. You can understand what movement in those top-line numbers does to their profitability. With microcaps, it's all about opportunities and blue sky.
I'll stay on you. I just want to know, is there like one or two essential ingredients that are needed for a microcap to grow?
Look, I think, firstly, you need to have a product or a service that has a clear competitive edge that is meeting a demand in a market there. But most importantly to us, you need a driven, passionate and aligned management team. You need a team of people that are going to work day and night to ensure the success of their strategy. And importantly though, as an equity investor, and often we're minority investors, you need to make sure that they're financially aligned with us. So you look at their incentives, their equity holdings, and make sure that all adds up.
So a strong management team and a great product or service.
Yep.
Is it the same for you, or are there other essential ingredients that are needed?
Yeah, completely agree with James. You definitely need that management alignment. I think having a solid strategic plan, often these early stage companies, they pivot from one side to the next depending on product successes, how well marketing campaigns go. I think, believing in their product, understanding what the total addressable market looks like, understanding what the industry tailwinds or headwinds potentially look like. I think those ingredients all make, all set up a decent criteria for these microcaps to grow into themselves and ultimately become much larger companies.
I personally feel like a lot of microcap investing is just timing and luck. What are some of the risks that you think investors should be aware of?
I wish. I think there's plenty of risks, and largely because they're earlier stage companies. So realistically, they rely heavily on capital markets being kind to them so that they can continue to raise capital to fund their growth. Typically, they suffer from lack of liquidity because of ownership being tied up in either management or board or founding shareholders. So small moves in share ownership can trigger large price moves. I think there's plenty of risks in this space. Particularly an over promotional CEO, I'd say can be a bit of a red flag. Particularly given if it doesn't necessarily line up with the fundamentals. But it certainly is a risky area of the market, which probably means you've got to rely on people that can do the fundamental work.
Are there any other risks that you would add?
No, really, just to kind of back up what Nick was saying, that the intrinsic value of a lot of these businesses is largely built around earnings that are forecast to be much higher in the future. And the growth that is required to get from today, where there's usually very little earnings, to much higher earnings, means that pretty much most things need to go right. So if you get a misstep from management or a change in the dynamics of their market or industry, these businesses can be worth not much pretty quickly.
How much would you typically invest in a new idea?
In a new idea, so look, we run pretty concentrated portfolios, so between 2 and 5% of our portfolio will go into an initial investment.
And then how would that change over time?
If the share price rallies and we don't see an upgrade in earnings, then we'll use that as an opportunity to take profits. But conversely, if we do additional research or if new information comes to hand that gives us greater conviction in our earnings, or means that we were probably a little conservative in our initial earnings forecasts, then we may add to the position.
Is it possible, Nick, that you could provide us like an example of a company that you invested in and then how that exposure changed over time?
Yeah, for sure. I think your level of initial investment depends on your comfort with the management team and the quality of the business. An example would be Hub24 rolled out of the ASX 200, I think 9-10 months ago. Very good quality management team, significant tailwinds in terms of industry, good business that's benefiting from platform consolidation. Purely was suffering in terms of valuation and lack of attention as a result of index moves. You got an opportunity to get involved in the stock, sort of sub $10. I think earlier this week it was announced to go back into the 200 and at that point the stock's back at 24. So I think it's, in terms of looking at that example, you can have a lot more conviction in the bet size because the business has been listed for a long time, and the reason why it's coming into your universe is largely a technical reason rather than fundamental. If I look at the flip side and say an IPO that's coming to market where the track record perhaps isn't as strong as you would like, you haven't got a whole history of financials or a relationship with the management team, you're probably going to be a little bit more cautious in terms of what position you would initiate at that point in time.
The buy now, pay later sector has really exploded over the past 12 months.
Yep.
In your mind, what's like the next growth sector?
I think, look, Afterpay in the sector has certainly been, almost a once in a generation phenomenon that we're probably unlikely to see the same level of magnitude and attention from both retail investors. Isn't that what this whole video is
about? We're trying to find the next Afterpay, Nick.
Look, I'd love to give you one, but I think realistically, even when we were early investors in Afterpay, when we owned Touch Corp and Touch Corp was bought by Afterpay after Afterpay listed post it. We certainly didn't think at $3 that it was going to go to 150. But that's the beauty of this sector. There's, people can engage with concepts, people can engage with good brands, good products, as James has talked to. And I think, for me, the sector that kind of stands out, I think, is online retail. It's clearly been a big COVID beneficiary as people have shifted from traditional bricks and mortar to online. But we're really only just scratching the surface. If you look at the penetration of online retail, particularly in the furniture and homewares category, we're at about 5% of a $14 billion market versus the US and the UK is closer to 15 and 16%. So for me, it's probably running a lot higher than 5% post-COVID, but it doesn't feel like it's going to settle at 5. It feels like it's going to settle a lot closer to 15 to 16%.
If you had to pick one company in that sector to climb its way up the ASX to the top 20, what would it be?
I think for me it's Temple & Webster. It's clearly been a beneficiary of COVID in terms of people not having the option to shop in the bricks and mortar, but ultimately it's just been a great awareness campaign for a quality business and people that understand both good quality customer service, ease of delivery, and the need to go down to your local Harvey Norman, etc., to pick out a couch is probably a thing of the past. And that stock, we think, with great management, proven unit economics, can certainly make its way up the ASX in the years to come.
Okay, James, your time in the hot seat. What sector do you think is the next buy now, pay later?
Look, similar to Nick, but maybe just a little bit of a broader view, is cloud computing, which obviously plays into online retail. So that had a lot of attention specifically in the media a few years ago, but it's growing just as fast, if not faster, than it was a few years ago, and it was again a specific beneficiary of the pandemic. So I think if you look at the number of businesses that still need to migrate from on-premise to cloud, if you think about the behaviour of consumers, how they're demanding mobility, more data and lower latency, any business that either supports the cloud, so stores or moves data, or uses the cloud where software as a service or platform as a service, is going to have significant tailwinds for a number of years.
Okay, and if you had to pick one stock to one day move up into the ASX 20, what would it be?
Look, as similar to Nick again, I'll caveat this heavily where it's going to largely come down to execution. But if I look at the structural qualities of Airtasker, which is an online marketplace, it certainly has the qualities that says it can be a much larger business than it is today. So it's going to IPO within the next month. its tech stack or its software is all cloud-based, which means it can scale very easily. So it can deploy to new geographies without significant investment in R&D or infrastructure, and it's already expanded to 3 or 4 new geographies at a pretty early stage in its life, which shows that it can do that. If I look at the network effect that's created by this platform or marketplace, once it reaches scale in a geography, it's really strong. So as new customers join the platform and as new taskers or task providers join the platform, the marketplace becomes stronger, which again attracts more customers, attracts more suppliers. So you get to a point where the top line growth just becomes self-perpetuating. So you don't need to constantly reinvest in sales and marketing to grow the top line. And then importantly with all these microcaps is the management team. So Tim, who's the founder, who's still the CEO, didn't sell a share into the IPO. James Spenceley, who chairs the board, founded and started Focus and turned that business from a small startup into a multi-billion-dollar telco. So it says that he has the skill and the experience to drive sustainable high growth for a number of years.
No, I use Airtasker all the time, so I feel like it's really exciting to see that IPO soon.
That's good evidence.
Well, James picked Airtasker and Nick picked Temple & Webster, but we'd love to know what you think. Let us know what stock you think can climb its way up to the ASX 20 in the comments section below. Remember to subscribe to our YouTube channel so you never miss an update.